It's no secret that the housing market is in bad shape. Home prices are falling, foreclosures are on the rise, and the market seems to be crashing. So what went wrong? This video will discuss the top 5 reasons why the housing market is ruined. Keep watching to learn more. Why are home sales expected to drop by 25%? And why are millennials so bad? The reason behind this is the 2020 interest rate reduction allowed, which causes homeowners to lower their monthly payments. The shutdown resulted in a record low number of homes on the market and a severely reduced supply of the leftover inventory. Because of the longer housing supply, it took high costs passed on to consumers. Both for rental and purchase, a high price is to be seen in the market. So let's discuss 5 top main reasons behind it. And if you enjoy such content, make sure to like this video, subscribe to our channel, and turn on the notification bell icon to never miss another upload of ours. Here we begin. Number 5. Expensive homes become more affordable, but cheaper homes will become more competitive. The housing market is in a constant state of flux. Prices go up, and then they come crashing down again. It can be difficult to predict what will happen next, but some underlying factors can give us a clue. Here are the top 5 reasons why the housing market is ruined. Supply and demand. When there are more buyers than there are homes available for sale, prices go up. But when the number of homes on the market starts to outpace the number of buyers, prices come back down again. It's simple economics. Lending standards. Lenders have become much stricter in recent years, making it harder for people to get mortgages. This has had a cooling effect on the housing market, as would-be buyers are forced to rent instead of buy. Unemployment. When people lose their jobs, they can't afford to buy a home. This has been a major factor in the housing market crash of 2008 and the subsequent recession. Income inequality. The gap between the rich and the poor is growing, which has affected the housing market. As a result, more and more people are being priced out of home ownership altogether as properties become increasingly unaffordable. Political uncertainty. There's a lot of uncertainty in the world right now, and it's affecting the housing market. Buyers hesitate to make big decisions like buying a home when they don't know what the future holds. These are just a few of the factors that are affecting the housing market. It's a complex issue, and there's no easy solution. But if you're considering buying a home, it's important to be aware of these factors to make an informed decision. Number 4. Expect less competition. The housing market is in a rough patch right now. Prices are skyrocketing, making it difficult for buyers to save up for a down payment. And even if you do have the money, there's no guarantee you'll find a house you like. The selection is slim and the competition is fierce. Here are 5 reasons why the housing market is ruined. Firstly, it's harder to qualify for a loan. Secondly, lenders are stricter with their requirements. Thirdly, there's less inventory of homes for sale. Fourth, home prices are rising faster than incomes. Finally, the rent is increasing at a rapid pace. These factors all work together to make it difficult for people to buy homes. And as long as these trends continue, the housing market will remain in a slump. If you're thinking about buying a home, now is not the time. Wait until the market improves and then jump in with both feet. Otherwise, you'll be risking your financial future. Number 3. Home price appreciation will slow. The average person cannot afford a home. The cost of living is too high. The economy is not good. The job market is not good. All of these factors have led to the downfall of the housing market. The average price for a home in the United States is $188,900. This number has been steadily rising over the past few years, and it doesn't seem to be slowing down anytime soon. In some parts of the country, such as California, the average price for a home is well over $500,000. This makes it nearly impossible for the average person to purchase a home without taking out a large loan or going into debt. The cost of living is also incredibly high in many parts of the country. The average person spends a significant amount of their income on housing, food, and other necessities. This leaves little room for savings or to afford any luxury item. The job market is also not looking too good these days. Many people are unemployed or underemployed. This means that they are not making enough money to cover their basic living expenses, let alone save up for a down payment on a home. All of these factors have led to the downfall of the housing market. As a result, it's become increasingly difficult for people to purchase homes, and the prices continue to rise at an alarming rate. Number 2. Mortgage-backed securities rates will rise. The subprime mortgage crisis was the housing market's collapse that began in 2006. The crisis was caused by a number of factors, including the lax lending standards, excessive borrowing, rising home prices, and weak regulation. These factors led to a situation where borrowers were taking out loans they couldn't afford to repay. When borrowers started defaulting on their loans, it put pressure on the entire housing market and caused prices to fall. This cascading effect led to even more default and further price declines. Ultimately, the subprime mortgage crisis resulted in millions of Americans losing their homes and billions of dollars in economic losses. Number 1. Foreclosures will rise. The housing market is in shambles and there's no denying it. Though this is many reasons, we've compiled the top 5 reasons that seem to be at the root of the problem. So if you're thinking of buying a home or selling your house, be forewarned, things aren't looking too good. First reason is that foreclosures will continue to rise. This is because people are still losing their jobs and taking pay cuts, which makes it difficult to keep up with mortgage payments. And as we all know, people go into foreclosures when they can't pay their mortgages. So foreclosures ruin the housing market by lowering home prices. More on that later. And they also ruin people's lives. The second reason is that even if you do have a job and can afford your mortgage payments, you may not be able to get a loan. This is because lenders now require higher credit scores and larger down payments. So even if you are employed and have good credit, you may still have trouble getting a loan. Now, what can a person do to cope with the situation? Besides the Great Recession, the latest major housing crash occurred during World War II in the 1930s and 1940s. Crashing is far less common than many believe, but the recent scar of the Great Recession has left many worrying that they are in a housing bubble after several years of record price growth. As more housing data comes in, it's becoming clear that the real estate market is cooling. Of course, the verdict on whether or not a housing market crash will occur is still out, but those who are highly concerned can rest on acknowledging these 3 things. Firstly, down markets are great opportunities to buy. The real estate market, obediently following the initial crash from 2007 to 2008, led to tremendous buying opportunities for those with the capital and the knowledge of the same. The higher inventory, as well as less demand, lead to deflated prices of the real estate, and the lower prices of real estate will lead to better returns, as well as better appreciation down the road. It is highly essential to remember that the mortgage rates are rising simultaneously, and with the inflation remaining somewhat untamed, the rates will highly increase. Higher rates mean a higher cost of making cash, borrowing cash, etc., even after a crash. On the other hand, those with the private capital and the funds available can take advantage of low prices and be rewarded for buying low. Secondly, low leverage will be the best risk hedge. In some of the down markets, rental demand could falter and could have led to higher vacancies or lower rental rates, which can eliminate or reduce the cash flow. Suppose the demands get lower and is sustained for anywhere from some months to some years. In that case, it is your responsibility to float the expenses of the property and its cost until it becomes profitable again. If a person is highly leveraged, that is, they don't have any extra money to cover the costs and expenses, they could be forced to sell while the market is still going down. So having an emergency fund for future investment in properties is a great idea. Of course, the more you have saved, the better it is for you. But having around 3 months to cover the debts and expense obligations is a great place to start. Finally, the housing market will surely recover. Markets never stay down forever. After some recessionary periods where demand and values fall, markets will somehow rebound. For example, during the Great Recession, one of the worst housing market crashes ever, the value of the property fell by 37% over the time frame of 6 years. After 5 years, the housing market returned to its pre-recession peak and somehow continued to increase to 59% in the next 5 years. No one ever wishes to see any property's value dropping, but any loss in value is highly captured if the person decides or gets forced to sell it during the crash. Remember to take the long-term approach of writing and investing during the downturns instead of selling, which will surely help avoid any losses. It is a great idea to focus on cash flow over appreciation for investment properties because the cash flow will help the investment remain profitable even when the values go down. The moral of the story is that the housing market is a mess. It's been ruined by various factors and it doesn't look like things will get any better soon. So, considering buying a home, you might want to think twice. But surprisingly, none of the human beings can ever expect what is about to come. Thankfully, the down market doesn't have to be a bad thing, and keeping these 3 things in mind, a person can easily ride out the storm and will surely be in a better position due to it. Thanks for watching, and don't forget to like, share, and subscribe for more updates.